Bank toxic assets explained, what they are, why they matter, and how they impact the economy. Hello everyone, and welcome back to the channel. Have you ever wondered how some banks suddenly collapse, require government bailouts, or trigger financial crisis? One major reason is something called toxic assets. The term became globally famous during the 2008 financial crisis when some of the world's largest financial institutions faced massive losses due to assets that rapidly lost their value. In today's video, we'll explore what toxic assets are, banks hold them, how they become dangerous, the role they played in the 2008 financial crisis, their impact on banks, and economic strategies banks use to manage toxic assets. By the end of this video, you'll have a clear understanding of one of the most important concepts in modern banking and risk management. Let's get started. What are toxic assets? Let's begin with the basics. A toxic asset is an asset that has significantly declined in value and has become difficult or impossible to sell in the market. The word toxic is used because these assets can contaminate a bank's financial health. Imagine you bought a property for $1 million. Suddenly, the real estate market crashes. Nobody is willing to buy the property. The property's market value falls to $4 lakh. In this situation, the asset has become highly risky and potentially toxic. For banks, toxic assets typically include defaulted loans, bad mortgage, non-performing loans, NPLs, mortgage-backed securities with poor quality underlying loans, distressed debt instruments. These assets continue to sit on the bank's balance sheet while generating little or no income. Why do banks hold toxic assets? You might ask. If these assets are dangerous, why do banks own them? The answer lies in normal banking activities. Banks earn profits primarily by lending money. They provide home loans, auto loans, personal loans, business loans, commercial real estate financing. When the economy is strong, borrowers repay their loans regularly. But during economic downturns, businesses fail, unemployment rises, property values decline. As a result, many borrowers cannot repay their debts. Loans that were once valuable become risky. Over time, some of these loans transform into toxic assets. In many cases, banks may not even realize the extent of the risk until market conditions worsen. Types of toxic assets. Let's examine the major categories of toxic assets. Non-performing loans, NPLs. These are loans where borrowers stop making payments. Typically, a loan becomes non-performing after 90 days or more without payment. Examples include defaulted business loans, delinquent mortgages, and paid consumer loans. These loans reduce bank profitability and increase credit risk. Subprime mortgages. Subprime mortgages are loans issued to borrowers with poor credit histories. They often carry higher interest rates, higher default risk. During economic stress, these borrowers are usually among the first to default. Mortgage-backed securities, MBS. Banks and financial institutions often bundle mortgages together and sell them as securities. Investors purchase these products expecting regular income. However, if many homeowners stop paying their mortgages, the value of these securities can collapse. This occurred extensively during the 2008 financial crisis. Distressed real estate assets. Banks may acquire foreclosed properties from defaulting borrowers. If property prices continue to fall, these real estate holdings lose value and become difficult to sell. The 2008 global financial crisis. No discussion about toxic assets is complete without mentioning the 2008 financial crisis. Before the crisis, many banks aggressively issued mortgages to borrowers with poor creditworthiness. Financial institutions then packaged those mortgages into complex investment products and sold them worldwide. Everything appeared profitable, while housing prices continued rising. However, when housing prices started falling, Mortgage defaults increased property values, dropped investors lost confidence in financial products backed by mortgages, lost value. Suddenly, banks found themselves holding billions of dollars in toxic assets. Major institutions suffered enormous losses. Some famous examples include Lehman Brothers, Bear Stearns, Washington Mutual, Royal Bank of Scotland. The crisis spread rapidly through the global financial system. Credit markets froze. Businesses struggled to obtain financing. Millions of people lost jobs and homes. The global economy entered one of the worst recessions in modern history. How toxic assets affect banks. Toxic assets can seriously damage a bank's financial position. Reduced profitability. Banks earn income when borrowers repay loans. When loans become non-performing, income decreases. At the same time, loss provisions increase. Profitability suffers significantly. Capital erosion. Banks must maintain minimum capital requirements. Large losses from toxic assets can reduce capital levels. These can create regulatory concerns. Liquidity problems. Toxic assets are often difficult to sell. As a result, banks struggle to convert them into cash. Liquidity risk increases substantially. Loss of investor confidence. Investors prefer stable banks. When toxic assets increase, confidence declines. Share prices often fall. Funding costs may also increase. Impact on the economy. The effects extend far beyond individual banks. Reduced lending. Banks become more cautious. They tighten lending standards. Businesses and consumers find it harder to obtain credit. Economic slowdown. Less lending means less investment for new projects, reduced consumer spending. Economic growth slows. Increased unemployment. As businesses struggle to obtain financing, expansion plans are delayed. Hiring decreases. Job losses can occur. Government intervention. In severe situations, governments may intervene through bailout programs, asset purchase programs, emergency liquidity support. The goal is to stabilize the financial system and restore confidence. How banks manage toxic assets. Modern banks employ several strategies to manage toxic assets. Loan loss provisions. Banks set aside funds to cover potential losses. This helps absorb future defaults. Asset sales. Banks may sell troubled assets too. Private investors, asset management companies, distress debt funds. Even if sold at a loss, the balance sheet becomes cleaner. Restructuring loans. Instead of forcing borrowers into default, banks may extend repayment periods, reduce interest rates, modify loan terms. This improves recovery rates. Strengthening risk management. Banks now use sophisticated risk management tools. Credit scoring model, stress testing, scenario analysis, early warning systems. These tools help identify risks before they become toxic. Regulatory compliance. Modern regulations require banks to maintain higher capital buffers, better liquidity reserve, stronger risk controls. This reduces the likelihood of future crises. Conclusion. Let's recap today's discussion. Toxic assets are assets that have lost significant value and become difficult to sell. Common examples include non-performing loans, subprime mortgages, mortgage-backed securities, distressed real estate assets. These assets can reduce profitability, damage bank capital, create liquidity problems, trigger financial crisis. The 2008 global financial crisis demonstrated how dangerous toxic assets can become when risks are underestimated. Today, banks have stronger risk management systems, stricter regulations, and improved oversight to limit the buildup of toxic assets. However, understanding toxic assets remains essential for every banking professional, investor, finance student, and business leader. If you found this video useful, please like the video, subscribe to the channel, share it with colleagues and friends, and let us know in the comments. Do you think global banks are better prepared today to handle toxic assets than they were in 2008? Thank you for watching, and I'll see you in the next banking and finance tutorial.